Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. Canada's real estate market is in for a massive slowdown in the next 2 years once interest rate hikes and new rules on real estate investors come into play. This came out from a new report by RBC issued last week. Yeah, understandable. The Bank of Canada shocked experts and many investors last week when it maintained its key policy rate, keeping interest rates relatively unchanged. Following a year of record price growth, 26%, the sense of urgency is definitely understandable. This report issued by RBC paints a much more hopeful picture for those first-time homebuyers hoping to get into the real estate market. While it doesn't predict an all-out crash, the report does say that Canada is in for a massive slowdown this year, and that by the end of 2023, our real estate market should only be growing by 0.8%. which is a huge difference from 26%. So what I want to do today is go over the report findings, as RBC says there are 4 major reasons why Canada is in for a major slowdown, and then I want to have a brief discussion about the report's overall findings. We are expecting to get the real estate data for January this week, so of course we'll have updates on that, as the extent of our price growth will probably have a big impact on the extent to which policymakers impose new restrictions on our real estate market and the severity of those restrictions as well. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Well, the report does maintain the big caveat that we will probably see multiple bidding wars, at least for the first little bit of 2022, as inventories remain relatively low. The report moves on very quickly to say that interest rate hikes, which it is predicting that Canada will have 6 in the next 18 months, and with these rate hikes, buyers are going to be much more sensitive to their impact than they were, say, 15 years ago. As the prices of homes have gone up so much over the past few years, a 1% interest rate hike is going to make a much bigger difference than they did, say, 4 years ago. So buyers are going to be much more sensitive to these rate hikes, and it's going to help cool down the market substantially, says RBC. Not only are they going to hit buyers' overall affordability, what they think they can afford, it's also going to massively affect the qualification standards. Up until now, interest rates had been so low that buyers had to always qualify basically at 5.25, because with the best rate right now, say it's around 2.5, you would qualify at either 4.5 or 5.25, so you qualify at 5.25. But let's say these rates go up by 1.5%, 2%, as the banks do usually raise their rates a little bit higher than the increase from the Bank of Canada. So let's say they go up 2%. That would put your contract rate at 4.5%. So you would be qualifying at 6.5%, not that 5.25% anymore. So not only are these interest rates going to be much more difficult on home buyers' pocketbooks, but they're also going to make it much more difficult to actually qualify to get that mortgage in the first place. So RBC is really saying, first and foremost, interest rates are what is going to slow the housing market.
That'll do it.
Second, RBC puts a lot of stress on the new regulations coming down on real estate investors.
Regulations, directives, orders,
which, according to a new report from the Bank of Canada and according to RBC itself, constitute about 20% of the current real estate market here in Canada. RBC argues that the federal government is working to introduce measures that would ban foreign buyers from purchasing non-recreational properties for 2 years, tighten down payment requirements for investment properties, tax gains on flipping properties, and curb excessive profits on investment properties. So what RBC is really saying is that because these new rules are going to change the cost-benefit analysis on real estate investors so much more than it has been in the past few years,
it's over for the little guy,
that they might be very well better off putting their money elsewhere, putting it into the stock market, putting it into other assets. But when money was cheap, it was definitely profitable for real estate investors to focus on houses. But with the new down payment rules coming, with higher interest rates, and with curbs on making money off real estate investments, it's highly expected that calculus is going to change an awful lot, and there won't be as much money to be made, which will push a lot of these real estate investors out of the housing market.
Go on, get out of the kitchen, go on, get out of here.
Third, RBC sees more supply coming online in the next year or two. While there have been supply bottlenecks in the past 2 years since COVID, it's highly expected that these are going to subside. In fact, we built 250,000 new homes last year, which was up from the 190,000 that we had averaged for the past 5 years. So clearly, if we have less demand from the interest rate hikes and from the real estate investors being pushed out, and we have more supply, this should help cool the housing market even more going forward. Fourth, and we heard this in Canada's Monetary Policy Report, RBC sees dwindling savings as being a big contributor to pushing down demand for houses in Canada. Well, once the pandemic supports are gone and people start to devote more of their money towards travel, towards services, they're not going to have as much money sitting in that bank account as they once did to put towards down payments on homes. While Canadians currently have their highest net worth on record, RBC expects that net worth to diminish once everything's opened up and once Canadians start devoting their money towards other things other than housing. In the past 2 years, really, housing has been one of the only things that Canadians could spend their money on, and as we've seen, spend their money, they did.
Yes, money well spent.
So very basically, rate hikes, regulation, more supply, and less savings are all going to work together to help slow down Canadians' housing market to about 0.8% in 2023, according to RBC. They even see a quick drop happening in 2022. While we did grow at, like we said, 26% last year, RBC sees us slowing down to just over 6% in 2022 and around 0.8% in 2023. So clearly RBC they're not predicting a crash, they're predicting a major slowdown, which although I'm sure a lot of people out there would like to see a crash, would like to see a 25% drop, which as we've talked about before is predicted by some economists. This is better than nothing. This is better news than continual 25% year-over-year growth, which as we said before is just completely unsustainable. One thing I do want to note though is that as with everything, this is also couched on if. If we don't get a new variant, if interest rates are hiked, if we don't see some other black swan event come into play to change the Bank of Canada's calculus, to change the calculus of the Federal Reserve and the rest of the central banks in the West, as long as they do actually engage in these rate hikes, which everyone is expecting, just about everyone is expecting, as long as that happens, as long as interest rates don't remain low forever, then it looks like we are in for a major slowdown of the housing market. And this was also talked about in the Monetary Policy Report, which we talked about last week, and now RBC is saying so as well. So the big things to look for are going to be the inflation rate next. The inflation rate is going to put even more and more pressure on the Bank of Canada to start the process of these rate hikes. So those numbers are coming out midway through February, and as always, we will definitely have an update on that. Click like and subscribe if you want to get those updates, and thanks so much for watching.